Hi everybody. So today in this video, I will teach you how to understand market structure properly without any bullshit advices. So let me introduce myself. Who am I? So you know me as a liquidity trader. I trade smart money concepts. Yes, forgive me because English is not my first language. I'm from India. So for that, forgive me, but I will teach you exactly how to understand market structure and you will understand it. So there is no issue. So first of all, this is what all bullshit traders teach you. They teach you this is higher low, higher high, higher low, higher high, higher low, higher high. And also known as swing high, swing low, swing high, swing low, swing high. But we all know that's not how market moves. That's not how market works. If it was so simple, everyone would have made money. All right. So this is how market moves. Swing low, swing high, then pull back, then breakout, then again deeper pullback, then again breakout, then again deeper pullback. And this is where people lose money. This is where people get confused by these pullbacks. Why market do that? To generate liquidity, to create orders, because as a car needs fuel to move from one point to another, market also needs fuel to move from A point to B. This is why price do these things. This is garbage, this is real. Alright. So now let me show you on charts how to properly do these things, how to properly market. So you can also do that, and believe me, this is the last video you need to understand market structures. So alright, let's jump into the charts. Before jumping into the charts, I want to teach you theory first because theory is most important and crucial. Once you understand the theory, then you will easily mark any charts. And yes, this thing work on any time frame, so don't ask on which time frame it will work with not. Market is fractal. Fractal means whatever happening is on the lower time frame will happen on the higher time frame. So everything is aligned and everything works everywhere. And yes, it works in stock market, crypto, forex, commodity, whatever the fuck you trade. It works everywhere. So don't ask of will it work on the stock market. It works everywhere. All right. So let's first understand the theory. Then I will show you the chart completely. So here is the theory. As we all know, these things does not work. It's garbage. It's bullshit. This work. So before understanding the market structures, you first need to understand how we define break and how we define liquidity graph, because they both look similar, but they work differently. All right. So for example, this is the market. It did a break of a structure. So we don't know if it is a break or it is a liquidity graph. Why we don't know? Because we don't have any information from the web. And not even priced it double break. So we don't know the first attempt is break or not. So to clear this confusion, we need to understand external and internal structure. All right. So this is the market, swing low, swing high, price made a retracement, then it did a break. Now we don't know it is a break or not. Then this is the external liquidity. This is the external structure and external liquidity. All right. When price took the external, then price came down. This is the internal point. Price took internal and then moved. So now this is the protected area. Why it is protected? First it did a breakout. Then it grabbed the internal liquidity. Means buyers got liquidated. This means this is a proof that institutionals are active and this point is protected. So this is the strong law. Then price did continuation, then pullback, then again break. Now we know that market is bullish. To make it easy, we need to understand one simple thing. We know price did break out. Alright, it means it is an external break. And every time when price did external break, it needs to grab internal liquidity. Now it's not always take internal liquidity. Sometimes it do this, then it do this. So what I'm trying to say is, when you see this pattern, when price did break out and then remove weak buyers, it means it is a strong area. It is a strong low. You can touch this area, you can macro demands on and whatever. So to read our market structure properly, we need understanding of QMs, mean quasi-middle models. This is super important. This is the advanced study. This is the real deal. So just keep one thing in your mind: whenever price break external structure, it will come down to break internal. Then you can trust this area. Otherwise, if price did this, you cannot take trades from this area because this is a weak. Why it is weak? Because it never grab any liquidity. Then price do this, and then you say my stop loss got hit. Alright, so let me show you on charts. So to summarize my point, I'm explaining last time what is QM. Price do three things: swing low, swing high, swing low, swing high. External break, price will take this and no this. Now this is QM. You need to keep one thing in mind: whenever price did external break, it will break internal, then external, internal, then external, internal, external. Sometimes what happen, price did with this, price did this, price did this. Price grab external liquidity, now it will again grab external liquidity and then it go. So price do three things: external to internal, internal to external, and external to external. And whenever price stuck in a range for longer period of time, then it's to internal also. So now let's understand the practical thing on charts, how to mark our structure. This is the Nasdaq 4-hour chart. This thing work on any time frame, does not matter. So this is the chart. Whenever you mark a structure, start from daily, from top-down analysis. For study, we are understanding 4-hour chart. So you can see this is my Nasdaq chart. Now on this screen, if you are a beginner, just keep the chart on your screen, zoom out 3 times, 2 times, 3 times, and then see whatever is the highest point on chart here, whatever the lowest point chart here. So now this is your range. You will trade between this range and let's start marking your structure. So we can see this is the break of a structure. What price did break? And after break, what did it? Grab external liquidity, means now it will grab internal liquidity. So price won. This is what price did: grab internal liquidity, external liquidity. It means now you can trust this area. What price did? Pull back, continuation. Did price grab any internal liquidity? No, only continuation. Then this is our strong low, this is our strong high. Now price what did? Grab external liquidity and trying to go upside. Of course here it was supply zone, price made pull back. Alright. So whenever you will mark the structure, you need this thing. This is your range 1. This is your protected area. And this is your range 2. And you will trade always between these range. Let me show you more examples. This is Nasdaq again, Nasdaq chart. Here we are bullish. Let me increase the size of this so you can understand it clearly. Here we are Nasdaq bullish retracement. Let me use the arrow. Here is a Nasdaq swing low, swing high. Now price grab external liquidity, right? Now what it did? Swept internal liquidity and then broke external liquidity. Now after external liquidity, what will price do? It will grab internal liquidity, try to go up. Because the liquidity was very low, it needed another attempt. Then it moved, break external liquidity, pull back, external liquidity. Is this low break any internal liquidity? No. Now price verdict, broke external liquidity and keep going up. So here is our next chart. Break of a structure. Break of a structure. It swapped internal liquidity means protected range. Again external, internal. Again external, external, external to external. Why price swapped external to external? Because there was no enough liquidity for market to move upside. Then breakout. It means now this is protected. Keep this in your mind whenever price was bullish. And it swapped internal and then broke external. It means this area is protected. You can trade from this area. Whenever price do this and just take pullback and never ever trade from this area, this is a smart money trap. Then price will take this out and you will get liquidated. Then price will move in your favor. This is the major issue people face. They know the direction, but they got liquidated. Now this is Nasdaq. What Nasdaq did here? It grabbed liquidity. It means this range was protected. Now price made a pullback. Now price what did? Grab liquidity. Grab liquidity. It's all. This range was protected. Okay. Now price swapped internal and then what it did? It broke the external. Now whatever you are seeing between this thing, like price swap internal, this is complex pullback. This is advanced market structure. I will show you in next video, because if you learn everything on one video, you will get confused. But today in this video, you just need to remember that after every external break, price need to break internal. Only then you will trade. Otherwise, you will not trade. You will wait. If price did this, you don't trade from this area. Why? Because this is not protected. This is smart money trap, and price will liquidate this and then break. Let's understand for examples more. Bearish side, if I believe. This was bullish. Let's see another bullish example. This is Nasdaq. Whatever did is breakout, pullback, break, external break. What will price do? Swapped internal, then again external break, pullback, external break, swapped internal, made a complex pullback because there was not enough liquidity. This range is protected, as we know. Why? Because it swapped internal liquidity. External break, pullback, external break. There was internal liquidity, swap the internal and again external. After external, swap the internal, made a complex pullback and then again bullish. So here is the key thing. Internal swap, break of a structure, internal swap, complex pullback because not enough liquidity, external breakout, pullback, external breakout, internal, external, internal swap, complex pullback, external break, protected range. Alright, this range is protected, so you can use this range. Here you can caught a trade which didn't work. Why it didn't work? Because there was not enough liquidity. Then price did what? Broke external liquidity all the way down, and then when it generated enough liquidity, then move all the way up. This is how they shake out traders. This is how they liquidate traders time to time on a regular basis. This is what traders more understand. So let's end this video, and to summarize, let's summarize this video. This is swing low, this is swing high, this is swing low, this is swing high. Alright. Now price break external. You need internal swapped. This is swing high break, break of structure, external liquidity grab. No price will swap internal, external, internal, external, internal, external. Alright. So this is your protected area. you can trade from this area. This is same for the downside. Let me show the downside once more. Swing high, swing high, swing low, swing high, swing low. After we break this is not protected because this didn't swap. I will swap this. Now you can trust this. Why? Because it broke internal liquidity and then external. Then what will price do? Made complex pullback. Again, you cannot trust this because it never swap had internal. Then price will swap this and again break. This is how a market structure, and this is the proper understanding. Alright guys, let's end this video. In the next video, I will show you what are these things, what are these complex pullback, and how you can understand them, because 95% times market will make complex pullbacks, not simple pullbacks. Why? Because price need orders, price need liquidity of retail traders and institutional traders. Alright, so let's end this video. Thank you for watching. If you love my content, please share and subscribe, like. I will teach you everything about trading for basically free.